Andrew Siciliano. He is KPMG's Trade and Customs Global Practice Lead. Andrew, aside from the fact that you're probably not sleeping at all, nobody on your team might be. A lot of CEOs and CFOs are watching CNBC right now. What is your guidance to them?
And you're absolutely right. There's a lot of truth to that. We have been working day and night helping our clients navigate this disruption. It's been a real fire drill. We're calling it tariff triage. The tariffs last week when they were announced were really widespread, much higher than expected. Companies are focused on cash flow, the current orders, the complexity of these new rules. So it's a lot to consider. Long term, what companies are doing right now, they're pulling every lever they can to minimize these tariffs. So they're looking at supplier diversification, negotiating contracts with suppliers and customers. They're looking at onshoring more goods, and they're also looking at tariff mitigation. So that's something that has always been an opportunity for companies to strategically look at what they're paying. Now everyone is taking advantage of every single opportunity they can to prepare for these tariffs.
What is tariff mitigation?
So, Brian, that's a great question. So let me just start from the basics. So there's kind of three pillars when you pay tariffs. There's the country of origin, there's the tariff classification, and there's the valuation. You need all three of those to determine what tariffs apply. So let's start with country of origin. The country of origin is where the good is basically made or transformed, substantially transformed. It's not always the country of export. So just because you buy a good from China doesn't mean the country of origin is China. So a lot of companies don't realize that, and they rely on the country of export. Easy to get wrong. The classification is also going to drive which tariffs apply. Every good is classified when it's imported. Really, really important to get that right. And then the value of the good. The valuation rules are very complicated. You have to make sure you have the right transaction, the right values included. Some values are not dutiable, and you have to make sure that you're using the right method of appraisement. There's different types of ways to value the good. So you got to get those three right. From there are a couple opportunities that just came out last week stemming from the reciprocals. So one of them is country of origin tracing. So what does that mean? 20% of the value of the good, if it's U.S. origin, you could exclude. So you could mitigate your tariff by excluding the U.S. origin. So how do you know what goods are from U.S. origin? So you have to go out and get certificates. You have to authenticate what's from U.S. origin.
This is happening, Andrew, and maybe this is why, and you don't have to speculate on this, I will, but maybe this is why the government this morning on Peter Navarro and Squawk Box said we're kind of pushing back on Vietnam, because I think it sounds like they're afraid that China goods could go through Vietnam, right, northern Vietnam, and then come through and say, oh, we're not going to tariff the Vietnam product, even though it's actually a China product. We're seeing that now from the Biden tariffs on solar panels, are we not? That it's hard to track. It's not political. It's just hard to keep track of where something is actually from if it moves through a couple of different nations on the way here.
Brian, that's a great point. Not only is it hard to track the finished good, it's even harder to track the materials to exclude them from the value. So companies that want to take advantage of that 20% U.S. origin. So let me be clear, if the good has more than 20% U.S. origin, say it has 80% U.S. origin, you could exclude all the U.S. origin, but you got to prove it. That's the hardest part. So companies are scrambling to put systems in place, and that's what we're helping them with right now, just supply chain traceability.
Andrew Siciliano, KPMG on the global trade side. Good real-world lesson there. I know a lot of CEOs and CFOs are watching.